Welcome, everybody, to a new episode of This Week in Intelligent Investing. Not sure the name really fits anymore, given how much time goes by between these episodes, but Elliot and I are on it, and hopefully we'll have this a little more frequently going forward. Today, it's such a pleasure to welcome our podcast co-host, Phil Ordway. He is not rejoining the podcast, but we do have this opportunity to see what Phil is thinking about where we are in the market, the state of the AI capex spend, and anything else we can get into that might be of interest. So, Phil, glad you could join us today.
It's good to be with you guys. I've been meaning to do more of these and catch up with you guys more often, and I've been totally derelict in those duties, so I apologize for the timing, but it's good to talk with you both. I've been missing these conversations, especially when we have such a goofy, weird investing environment like we do now. It's always good to talk through some things with other smart people and see what I'm missing. So looking forward to it.
Yeah, likewise. Elliot?
Yeah, excited to have you back. I've been very much wondering what you'd have to say about certain things in this environment. And I think it would be interesting to hear, many people are calling this a goofy environment, but I think some people come at it from different angles than each other. So what would you say are some of the most goofy things you're seeing out there nowadays?
Yeah, it's funny because there are so many goofy things, but I was just talking about this with somebody this morning who was like, well, I should just completely bail out of everything. And I'm like, whoa, whoa, whoa. I wasn't trying to go there. I'm not in the camp that, this is 1999 all over again and the S&P 500 is destined for a train wreck. I think a train wreck is certainly on the distribution of probabilities somewhere because of everything that's going on. But, some of the numbers make decent sense in terms of the broader markets. And then there's some things that just really make me scratch my head. I mean, you look at just all of the conflating evidence that just points in different directions, the contradictory points of evidence, I guess I should say, it's really hard to wrap your brain around how you've got, a relatively mixed macro environment, right? With inflation still running well above 3 or at 3, and we're cutting rates. And you've got a weak dollar and a strong equity market, and you've got record low corporate credit spreads. That part really makes me scratch my head, is that we've had, such benign credit conditions for so many years. And obviously Jamie Dimon made his famous cockroach comment a few weeks ago, and we'll see if that bears out. But it definitely makes you a little nervous, I would think, to be piling into, 5 or 10 year corporate obligations at 88 over or 105 over or something. That just seems bananas to me. So I don't know. That stuff definitely makes me scratch my head. I mean, we're definitely in a speculative environment. I mean, I was thinking, I kind of made a little laundry list before we did this. I mean, if you just look back at the last 5 years and forget about COVID, obviously, completely world-changing event, or some of the things in geopolitical events, whether it's in U.S. politics or the various geopolitical wars and conflicts that are going on that are massive and tragic and definitely changing the shape of the world. But think of the things that if I had explained them to you 5 or 6 years ago, that you would just not be able to wrap your brain around, like meme stocks, right? And the fact that meme stocks are back again, it's like a zombie. We're meme stocks 2.0 or 3.0. I can't wrap my brain around why people keep doing this kind of stuff. And there's some, I've read and talked to people that can give me the actual, kind of psychological or cognitive reasons that people do it. But, when you continue to see things like that, or really like the Bitcoin treasury companies, right, are a great example of it. And, love him or hate him, I've always found the hate for Jim Chanos to be ad hominem and really directed at people that can't get out of their own way in terms of their own self-interest. And it's like his trade here to own Bitcoin and short the shares of the company, its Strategy, Michael Saylor's company, is exactly what they're doing, right? I mean, they're selling equity to buy Bitcoin, and that's what he's doing. So I don't understand why it's such a controversial, horrible thing. But anyway, those are some of the things right off the top that just kind of blow my mind. And I again, I don't want to sit here and say, oh, we're in a massive bubble. It's guaranteed to be, March of 2000 any day now. I mean, there's obviously some similarities, but there's some things that are totally, totally different. So I don't want to overstate the case.
Yeah, one thing that's interesting that's both similar and different, the market is so narrow. And by that I mean if you look at the S&P, you'd think everything looks up and to the right, but if you look beneath the surface, there are a lot of names making 52-week lows. And basically anything consumers really weak. And I think one thing that's been fascinating to me of late is you look at a lot of the companies that if you were to just go back like 6 months, if not maybe a year ago, and these companies were what everyone would agree were compounders who'd, with fairly low vol, gone up and to the right for a decade. A lot of these names have cracked really, really hard in just the last 2 months.
Right.
I'm thinking about names ranging from Ferrari to Constellation Software to Gartner, and I could list like a dozen or so alongside that, but I just think it's really notable how these perfect companies that had done phenomenally well are really getting annihilated, and consumers just been
Yeah.
a dead place for several years. So on the other side of the ledger, you have the AI stuff mooning with Palantir at 100x sales, and most people don't even know what they do. So
I
yeah,
certainly don't. I mean, I'm still waiting for somebody to give me a cogent explanation of what exactly they do. When you go read their disclosures, when you read it twice or three times and can't make any sense of it, that's usually a bad sign, at least for me. So yeah, I don't know. Palantir is one where that's a real head scratcher. That's one where it would be like, wow, I can't even begin to figure out what's going to happen in the future here, and would make me really, really nervous if I had any real exposure to this. But I'll say two things in response to that. Like, one is that as you talked about how quote unquote narrow the market is. I mean, it's definitely concentrated at the top, and you definitely have the top 5 or 10 mega cap tech companies driving everything forward. I was what was it? It was March. No, it was April or May of 2024 when Nvidia had crossed from 2 to 3 trillion, and then just this week or last, it hit 5 trillion. And those are big, big numbers. Where I did the math for some of the MBA students I was with at that time, and this was again 50% lower than where we are today. And you have to the math has to be such that by 2038 or 2040 that Nvidia is commanding something like 1 or 2% of US GDP in free cash flow. And that assumes, that US GDP keeps growing, right? Not today's GDP cash. It's insane, right? So, and Nvidia is an amazing company, and I'm not saying it's an obvious short or anything remotely close to that. I just think it's really, really difficult to justify some of the individual valuations. Some of the other valuations are just much more reasonable. Like, if Alphabet and Google figure out what they're doing here, I mean, there's so many things that could go right for them. That could totally work. Amazon, same sort of thing, right? I have no opinion or comment there, but I would say that, the fact that they're so important to the market is definitely notable. And so maybe you would have something somewhat analogous to what we saw 25 years ago, where, there's an opportunity for quote unquote value. And I hate that term, but to do well while the rest of the market does really, really poorly for a period of time. Because again, there's a case now where I think it's just stunning. And I was talking to a good friend of mine yesterday about this. I didn't really pay attention or realize that some of the mega cap tech companies are now raising debt to put into all this spending on AI, which, again, I just had kind of assumed they, massive margins, great free cash flow, capital light. Like, I just assumed that they would be spending within cash flow to do this. And then I went and found out, no, they're actually raising like tens of billions of dollars in the bond market and doing SPVs off balance sheet. And the SPVs really got my attention. Like, why would Meta need to do or want to do an SPV off balance sheet? Like, it can't be for a better rate, right? I mean, Elliot, is there something I've missed as to what the strategy is here, other than just a game of hide the pickle?
uh, I mean, I think let's draw a line between in the very large companies, Oracle tapping debt markets versus what Meta's doing. I think they're a little different in nature. My sense with Meta, and full disclosure, I'm long shares of Meta. I think for them, it's about how much they're investing in the metaverse already. So $18 billion of loss per year on a segment that's shown no ROI yet.
Mhm.
And also simultaneously trying to invest even more into AI from a position where they're, maybe the fifth best player If you're really generous, you could call them the third best player. So they're playing from behind to begin with. And unlike Google and Amazon and Microsoft, they don't have the cloud business where they could obviously fill their CapEx with immediate customers who are willing and able to pay. Whereas Zuck's talking about, hey, our hedge is that we'll build this and we'll grow into it in a few years. I think it is, to a degree, exactly what you're saying, trying to hide the 8 ball, which is they want to show less total spend coming through their income statement so that it doesn't look quite as bad. But hey, the cash flow's there, the opportunity's there. They could cut their metaverse spend and support all this incremental CapEx if Zuck were to make that choice. So I don't think it's quite as cynical. The Oracle case is especially weird to me, where you're talking about $300 billion of this very far out 2030 commitment from a customer they will not name, but we all know who it is. Or maybe we think it's one of two people. And that spend, they'd even used qualified language. Like, there are chances it might not come, but they're going to have to invest, a significant multiple of their invested capital to date. So they've been around.
That's what I mean. Yeah, it's a big bet. It really is. You're right, because they've been around 20 years now, right? And this is a big bet.
40 years.
Oh, no, sorry. I thought you were talking Meta. No, yeah. Oracle.
Oh, yeah. No, I had switched it to Oracle there. But yeah, for both, it's a huge bet. It's a huge change in the capital intensity of the businesses. It's
that's one thing I guess that you're 100% right. A massive change in the capital intensity of these businesses, where historically that was one of the things that made them so appealing and made them worth a higher multiple than, the market leading companies of prior market cycles and prior generations. And so now is it not only, higher capital intensity, but I think they would all agree. And this is where I do get nervous, is that when people say, yeah, you're correct, and the but just doesn't explain anything. And in this case, the thing is that they all pretty much admit that, let's say there are 5 to 10 companies that are just all in, spending like crazy on this, whether they're spending from behind, like you said, in Meta's case, or spending in the front, like, I don't know who the best example would be, Microsoft. Alphabet, fine. Yeah. So regardless of which angle you're coming at it from, there aren't going to be 5 to 10 winners, right? There's going to be 2 or 3 at the end of this, right? Because you still need the scale, you still need the resources, you still need the relationships and the ability to pull this thing off, which is massively difficult and complicated and uncertain. So by definition, you're going to have tens, hundreds of billions of dollars, maybe $1 trillion destroyed in this arm race. And you have to be on the right side of that. And if you own the whole thing in an index fund, over 5, 10, 15 years, it probably comes out in the wash. But in the short run, there could be some serious carnage here.
I've had a historical analog, and I can't remember which one of our early episodes it was where I talked about this, but the book Merchants of Grain, I think, is an interesting roadmap where it's a completely unrelated industry, but I think there's some parallels where these great international grain companies started as zero capital, effectively brokers to sell grain, and they ended up completely verticalized, getting into the most capital intensive of industries, ranging from owning the silos first to owning the ports and the infrastructure to get grain to where it had to go. And there were amazing businesses through that transition, and they built moats and barriers to entry in going down the verticalized route. And it took, half a century before the incremental returns really started being quite poor and raising questions about whether these companies should even be one integrated whole in that direction. And so I kind of draw this line between those companies who have recurring revenues and have real businesses, and they're investing into verticalizing their capabilities versus companies like, you talked about NVIDIA. One of the problems I foresee with NVIDIA is, and I've owned this in the past, and I've owned it through some of the challenging parts of its history. It's a cyclical at the end of the day. There's no
yeah, right.
There's no question that at a certain point when this build out's done, the only question is how long this once in a generation build out will last for.
Yep.
Well, actually, there's a secondary question, which is if someone else's chips could supplant them in some ways. But let's assume that never happens. At some point, you still have a 50 to 60% decline in their revenues when you go from build out to replacement spend. That's absolutely going to happen. That's not going to happen for Google because they don't have this one-off in nature revenue to the same degree, there might be some revenue that they're getting in the cloud side from people who don't necessarily monetize their own AI spend that slips off, but that'll be more around the edges of what they're capable of doing. And I'm drawing this distinction because I think there are like two kinds of companies, like NVIDIA, Broadcom, and Oracle would be in this kind where there's definitely risk that it's not recurrent revenue and you're capitalizing something that might not be there at the end of the day.
And that's what I mean. Like, forget about the depreciable life of the chips and all the accounting issues that are real, and we can circle back to that in a minute. But to your point, like in the math, it's kind of inarguable here is that you need to get massive free cash flow out of NVIDIA in 2035 to 2040 to justify a $5 trillion market cap, something on the order of 1 to 2% of US GDP, which would be plausible, I guess, if the world changed zero between now and then, which is to say that NVIDIA has like the dominant monopoly position in this world, and it's just going to continue in a straight line from between now and then. Why would that be the default assumption? Why wouldn't something else come along and knock it off the throne? I mean, Jensen's basically said he's expecting that, right? Like, I find it really odd that that's the assumption.
Yeah, I mean, I think it's partly because NVIDIA has been so capable of staying one step ahead of the curve every step of the way.
Yeah, it's been very impressive.
There's a degree to which, like, because I think it's less talked about colloquially, but like they do have a big advantage in having developed the CUDA software platform behind their chips. So even people who are trying to compete with them have to at least embrace what NVIDIA has innovated on and brought to market. And yeah, I think there's just this kind of aura of invincibility around today's leaders. And it's
don't get me wrong, it's
people...
a super impressive company, right? So I'm not telling you, it's like one of the most unbelievable things I've ever seen in my life. It's just, to me, one of the iron laws of finance and investing is that everything that ends up as a disaster started out as a really good idea and just went too far, right? Like securitization of mortgages, great idea, just got taken way too far, right? I mean, name a disaster in financial history, and it was always like, oh, this made total sense, and then people just got carried away. And I don't have a position in any of these names that we're talking about right now. This is not investment advice in the slightest. It's just my, thinking aloud as to what's actually going on here.
Yeah, I've had Alphabet for a long time, which I should point out as well, just for completeness sake. But I think it is interesting to distinguish between, the kinds of companies that are involved in this, where they're coming at it from. And I think the history is really important to look at what happened in 99, to look at what happened with the railroad build-outs way back when, to look at any of these like amazing transformational technologies where capital is basically the accelerant for pushing through this transformation.
Right.
It always gets taken too far. I can't
really
think of an example where it didn't.
I can't either. That's what I was just about to say. I can't think of one thing that was transformational where it didn't get overinvested and overinflated on the way up, which ended up being super useful for society, right? Whether it was railroad build-outs or burying too much cable in the ground, fiber optic cable, that was all great. It was just not great if you were the investor holding the bag in the short run, right? Or if you were overexposed to it, or if you had a bad capital structure or whatever. And again, where I do get nervous, and again, I just can't figure out why a company like Meta would want to use an SPV structure to raise money. It's adding cost and complexity when they don't need to hide it. Like if you're Enron and you have nothing, I totally get using an SPV because then that is the game, right? Like that's all they have. But like Meta obviously has, it may not be Amazon or Alphabet, but it has a very real business behind it that's not going away overnight. They have a balance sheet. Like, why do they need to do this? Like, those are the kind of little tells. And likewise, I had another interesting conversation the other day that I thought was very telling, which was that this friend of mine was short. I don't know which one. He didn't tell me. I didn't want to know. Was short one of the data center related plays where, it's a massive assumption on how long these games are going to go, right? What's the depreciable life? How long do they need to be replaced? How long are the contracts? Like, it looks like a hot mess in a lot of ways because you basically need to run the table, right? It's like hitting a 5-game parlay in the NFL, which is another sign of speculative mania right now because those are the best margins for the casino and you do not want to be giving your margin to the casino. But anyway, this guy was pointing out to the fact that even if all 5 of these items in the parlay hit, you're talking about like a 2% return on capital for the data center company. There's just no possible way that they're going to earn their cost of capital over the next 5 to 10 years. And one of his LPs got really mad at him and said, I can't believe you're short this. He goes, why? And he said, because nobody cares. And the guy said, yeah, look, I know that nobody cares, but it's a 25 basis point position. I have lots of these positions on, like none of these individual bets are going to blow up the fund, blah, blah, blah. And it turns out the guy was actually, the critical LP was actually long this data center company. And he goes, so my friend said to him, why would you own this? I suppose I can get your criticism of why I should be short this if your argument is I should just avoid the whole giant mess. And the guy said, I'm long because nobody cares. So it's just this game of like, you got to dance while the music's playing, the famous, Chuck Prince line that everybody's going round and round. And I don't know, there's just all those behavioral tells that, Elliot and I were just talking about with John before we started recording. Like if you go back and read financial history, and it doesn't pertain too much, but you brought up the railroads a couple times already, and I just read The First Tycoon, which was a fantastic biography of Cornelius Vanderbilt. You go back and read about all this stuff, and it's like human behavior hasn't really changed at all. Like the way it's expressed has changed, right? I mean, now we have DraftKings and Bitcoin treasury companies, but the behavior doesn't change, and you see these behavioral tells pop up, and it's like, oh, I've seen this movie before.
Well, I could guess the company with 90% confidence. I've always loved when we do the episodes.
I should have been more
company.
I should have been more generic. I don't really know, and I don't have a. I mean,
it's certainly CoreWeave.
I don't know. I really don't. I'm not trying to be cute. I have no idea.
And I do think there's something interesting to that, which kind of circles back to a lot of what we've been talking about. There aren't that many mid cap and small cap names that are like outside of the utility space, by the way, which is a whole nother issue. But there aren't that many mid and small cap pure technology names that get checked off as AI winners or AI companies. And this was like the first IPO that I could think of where it's like their whole pitch to the market is we're an AI company. We have a special relationship with NVIDIA and we have a special customer base, like all these big boys that are winning. And so for someone who wants to find smaller players, you don't even have to think a lot. It's just like, oh, AI, mid cap, I'm in. And I think that shows, I don't know if I were to put an inning on this, I don't think we've seen this flood of IPO activity where there are a lot of smaller companies that are potentially beneficiaries. Haven't seen them all come to market, which makes me think, I mean, famous last words. I don't necessarily want to like make a bet on this, but to me that says we're more middle innings than later innings of this.
Yeah,
because there aren't that many opportunities to just like go crazy piling into like that.
No, that's entirely possible. And since you brought up CoreWeave, I mean, that was private for a long time, and there's a lot of these companies that are staying private for longer, and I guess the scarcity factor is part of the thing that's driving the whole mania. So you're right. I wouldn't want to bet on it. I wouldn't want to put an inning on it. But if there's one thing I've learned, thankfully through not too much painful direct personal experience, certainly some, but mostly vicariously, is that just because you don't think it makes sense or just because it objectively doesn't make sense, it can go on for a long time, right? I mean, it can really last.
You ever read the book Engines That Move Markets?
No.
It's awesome. It's basically like a case study of each of the major technological breakthroughs and what happened to financial markets and the leading companies. And I'm sorry, I'm going to give away part of the ending, but part of the ending was that if you want to be short these things, it was actually far easier to just short the losers from the tech breakthrough than to short the bubble stocks in the tech breakthrough.
I agree with that.
Yeah, I think that's part of what's happening in the market where like people see these losers. And by the way, that's not to say that every perceived loser is a loser, right? You have to be right about which is which. And
Right.
I personally think there are some emergent opportunities in companies who are perceived losers but won't be at the hands of AI. So leave that aside. But if you get the perceived losers right, those were much easier shorts and you'd have taken way less pain and blah, blah, blah. It's worth thinking about.
Yeah, oh, for sure. And look, I haven't shorted something in 10 years at least, and I'm very glad that I haven't because it would have been torture. A lot of the things I would have, pegged for a short portfolio would have been absolutely like eating glass for this whole period of time. But if you were going to do it, I agree, way easier to go out and try to find either structured trades that made sense. So like what Jim Chanos was doing with MicroStrategy or strategy and Bitcoin. Again, so like going out and saying, "Oh, I'm going to short, Nvidia, or I'm going to go short, Facebook or whatever." Like that seems like a terrible idea because even if you end up being right, like you have no idea what the timing is going to look like on the horizon that matters, and it's going to be really, really difficult in the interim, and the cost of carry is going to get pretty significant over time, and it's going to be really tough. And there's some of the obvious losers are going to get carried along with the tide for a while too, but like the clock is ticking more loudly for them when they're completely broken. So I totally agree with that sentiment.
Yeah, and I mean, I'll give an example of that. Not and full disclosure, I'm not short any of these stocks, but maybe one way to kind of express cynicism about CoreWeave would be to short some of the data center REITs,
Yeah.
where if someone like CoreWeave has such a low cost of capital and people don't even care about whether they make money or not, and they're building all this new supply, and yet these digital REITs are valued at a pretty expensive multiple anyway, that might not be a great thing for their future. I'm not saying they're a
Yeah.
good short. I'm just trying to express a logic and how to think about what the impact of AI might reap for some of these areas.
I think that's exactly right. Cause yeah, I think it's when people don't care or they're caring about the wrong thing, and that can change on a dime, right? I mean, again, think back to April when the tariffs got announced, and obviously that was a huge, circus, and it lasted for what 20 something days, and then people's attention shifted elsewhere, and we're right back into the middle of the rodeo. And it's like, people's attention can shift on this very quickly. So again, I don't know that much about the data centers. I've sort of looked at it at a high level. It seems very tenuous to say the least. And, people aren't caring about it right now because the attention's there, the top line growth is there, whatever. That attention can shift very quickly. Again, not a game I would want to play, being short those things, but I think it's a very dangerous, tenuous position for sure.
Yeah, it is an interesting time where you mentioned the tariffs. One of the things I keep thinking about, and I think a couple of my friends have this joke that nothing ever happens, but it's like so much is happening so quickly and nothing's happening at the same time. And it's all just a circus and chaos. And I feel like it's been a very weird year, to say the least.
Very weird would be my chosen description of it as well. And I don't know, like I look forward and I think, what's going to get inflation down to 2% or below, right? I mean, we're so used to inflation being really low and we're so used to equity markets going up. What's going to guarantee that that continues to happen for the next, I mean, we've really had it really ever since the bottom of the financial crisis, whether you want to call it 2009 or, you didn't fully feel like you're out of it until 2010 or whatever. It's been, and obviously COVID came in there and was crazy for a few months. And the Liberation Day tariff fiasco this year was crazy for, a few weeks. Like you just, and you had the flash crash, even all these little bumps along the road that felt like giant potholes for a matter of weeks or months. But in hindsight, like, we have not had a grinding bear market in a long time. And, you've got this massive uptick in gambling and quote unquote participation or engagement where people are just pumping money into stuff that they don't really understand. And that's not real great or real healthy. This isn't a moral argument against gambling. I just always like to separate gambling from capital formation, and they should be separate in my view. So I just think there's a very weird year would be accurate. And nothing was weirder to me than, and it's still mostly true today, but you could have made a really good argument earlier in the year that if you owned a 60-40 portfolio, or if you owned 100-0 portfolio, equities, fixed income, and really you could throw in a whole bunch of other asset classes in there, that it really didn't matter what you owned because it was priced to make like 4.5%. It's like, that's a little strange, right? Like that's not generally how that's supposed to work. And I think it just shows that like everything was kind of thrown into the blender and somebody turned it on, and here we are. So it's our job to make sense of it. And it's really difficult. I mean, again, I would not advise, I'm not advising, I'm not acting in a way such that I'm calling any sort of equity bubble. I'm not, I think if you can live with the S&P 500 making a 5 or 6 or maybe you get 7% a year compounded over the next 5 or 10 years, if that's fine, which it is, I mean, it should be fine. It's below historical average, but it's not a disaster. I think you're fine. But if you have expectations that you're going to make, continue to make 10, 12, 14% a year from here, boy, you're going to need to hit that parlay on AI, everything and a productivity explosion, et cetera.
And when you see your neighbor build a new kitchen and expand their house,
Yep.
and they tell you that they paid for it with their Palantir,
Yep.
the
100%.
pressure for better returns gets even stronger.
Yeah, I don't know who said it, but I think it's very true that like nothing drives people crazy or faster than watching their neighbor get rich when they're dumb or, doing things that are stupid. Right? And so, yeah, you're 100% right that if you're sitting on the sidelines trying to be Mr. or Miss Prudent Cautious Investor and you're watching your neighbor, load up on Palantir and buy a vacation home or blow out their kitchen or whatever, yeah, it's psychologically difficult for sure.
Yeah, that's one of the challenges of how narrow the market's getting. Because I know you made this point about how things had been relatively short-lived when we've had steep market drops. 2022 was like the longest market drop we had, and the economy did seem like it was turning for the worse, but AI bailed out everything. AI pulled up the economy, pulled up the stock market, but a good chunk of the economy never really, it's kind of just been bumping along,
That's
as
true.
you mentioned.
Yeah, that's true.
Inflation's still not under control totally, though we're cutting rates again. And many of these stocks, like we'd been talking about, the bifurcation of the market, there are a lot of sectors that have been in bear markets since 2022 and haven't really made new highs. And I think one of the contrasts that I look at that's somewhat notable is the Russell 2000 only finally made new highs above 2021 levels, but the S&P 600 has not. And theoretically, both those indices reflect the same factor, the small cap factor, but there's one critical distinction. The S&P 600 only takes in profitable companies. The Russell 2000 has unprofitable companies. And
it's
if you
like
were
half, right?
yeah, exactly. So if you disaggregate the entire delta in returns between the S&P 600 and the Russell 2000, all of the excess return in the Russell 2000 is coming from a handful of unprofitable names, several of which have like very good AI ties. So to that same point on the lack of opportunity to invest in small and mid-cap AI names, that's why the Russell 2000 looks like it's breaking out, but the S&P 600 remains in a bear market. So I think that's kind of a very challenging backdrop for active managers in general.
Yeah. Yeah. No, it's interesting. And I mean, one other, that's a fascinating, I had not looked back at the Russell 2000, but it's been so brutal to be, effectively one way or another long the Russell 2000 and short the S&P 500, at least on a relative basis. Like you've just been getting absolutely murdered. And it's interesting that you're right. I just pulled it up right now. The Russell 2000 in May, it looks like May of 2021 was the prior peak. And then it tried to get there in, what is this? Around this time last year, and then went right back in the dumper. And now it's finally gotten ahead of it. But yeah, it's really, really interesting. And I'll say this, I mean, in terms of, what we were talking about previously, I mean, one thought that keeps recurring to me is like, what is AI and this, supposed revolution? And I'm not disparaging it. I mean, I don't know. I'm not a technologist in the way that a lot of these, very informed, bright people are. But let's just, and I will say it does make me a little nervous that there are like basically no skeptics out there that are like, oh, AI is stupid, AI is overrated, AI is like way behind where people are predicting it to be in the short order. And so I do wonder if like maybe all these, these prognostications about how wonderful it's going to be are accurate, but it's like 5 to 10 to 15 years away and everybody thinks it's like 6 months away. I don't know. But anyway, let's say that everybody's correct and it's going to be the next greatest thing, right? I mean, when people were talking about the internet, they were correct in the sense that it all did change the way we live and it's been massive and it's been enormously successful in just about every way, but it was successful in ways that you didn't really imagine, and it probably took a lot longer. And there was a lot of displacement along the way in terms of economies and governments and societies. And so the US consumer right now is in a really weird place too, to use your term earlier, which I think is the right one. It's very weird. Like the top end's doing great, the bottom end's doing pretty poorly. Like the numbers are pretty scary outside of a recession if you look at like the bottom half or the bottom quartile of US consumer spending. And so if AI is going to come along and just turn the world upside down and eliminate massive amounts of jobs, what does that mean for consumer sentiment and consumer spending? Because it's still a consumer spending driven economy, right? It's like 2/3 or 70% of US GDP is going to be driven by that spending going forward. And so without getting into like some political arguments about needing universal basic income or something, like how does that work?
Yeah, and I mean, AI would have the exact opposite impact that it will or should, in theory, have the opposite impact of what you're alluding to, where it should have more pain, disproportionate pain on white collar, higher earners.
Yeah,
Um,
maybe. I mean,
because
I was
presumably,
just reading. I was just reading this article about how, by 20, I forget what the exact year was. I think it was 2030, but I could be slightly wrong. Amazon thinks they can replace, hundreds of thousands of blue collar workers with robots. And those are all going to be, fed in one way or another by AI. And they're not really possible without further technological breakthroughs. So I don't know. Like I am very pro technology. I'm very pro the importance of productivity growth. And, the Nobel Prize in Economics was just awarded to the study of what makes technological breakthroughs actually have teeth and stick and move economies forward. And it was this combination of like the idea itself and the culture and the environment and the rule of law to make it happen. And so all those things are in place. I am definitely not glass half empty on technology or AI, but it's just like there's so many arguments right now where it's like both can't be true at the same time. And so I feel like when everybody's on one side of the boat and they're arguing about all these things can be true once we can have our cake and eat it too, I just start to get a little nervous.
I think there's a degree to which like both things can be true. And just reading historical examples of technological revolutions, it both are right in the sense that there's a great degree of disruption, and inevitably new technologies create new kinds of jobs that you didn't even know would have existed beforehand. And
100%. Yep.
it's a
That's very true.
like this whole notion of structural unemployment. That's when it really matters amidst these revolutions. And it starts getting challenging to think about like what safety net you need for the people who are displaced by technology, what sort of training they could use. Like, are you really going to, as the workforce has gotten older, are you really going to train like a 62-year-old in a new vocation? Probably
Yep.
not. But like, what do you do for someone who'd just gone to school and is coming out and emergent in a field where AI is going to displace a lot of jobs over the next decade? They're really tough questions, but I do think there's a lot of nuance that we could apply here. And I do think both can very well end up looking right over time. And the extent to which they cause broader disruptions will be reflective of how we kind of handle as a society some of these questions about inequity that result from evolution and revolution.
Yeah. Right. The road will be bumpy because I share if it's a sense of optimism, I share it in that I think it's not the end of the world. There's some weird stuff happening, but it should all be fine. I mean, it should be a positive iteration of technological growth. It's just, I don't know. I don't think any of us would disagree. Maybe I doubt John would disagree, but we haven't heard from him. But, there's just this overlay of speculative behavior that, as you look at human behavior and psychology and you look at the financial history of markets, anytime there's been this much of a speculative fever pitch, it rarely ends well in the short run. And by the short run, I mean anything from 6 weeks to, 3 years or something like that.
And let's point out one more element of this society-wide speculation. We're talking amidst the NBA betting crisis, where you have players who made $100 million in their career and they're doing really stupid things that could risk more than risk, that make it likely they'll end up in jail for like $50,000
Yeah.
or
Yeah. I mean,
glory or what? Like, I don't know. That to me
but
says
that's a great
some.
example where, like, Adam Silver really, really pushed and was at the forefront of saying, let's embrace it. This will be good. We'll regulate it. We'll get in front of it. And really what they wanted was the eyeballs and the ratings and the revenue. And it's like, you can't have it both ways. Like, you can't push gambling down everybody's throats and then expect stupid things not to happen. And you can't expect to say, like, oh, we're going to just have a bunch of 1-800 numbers for people to call if they have a gambling problem and not expect it to have like significant negative societal effects notwithstanding. So that's a great example of like, oh, wow, I'm completely shocked. Like you push gambling really hard and then you got a massive gambling scandal. That's probably just the tip of the iceberg, by the way. Like that's a perfect metaphor.
And not to be all cynical about Michael Jordan's own history, but the league should
Oh,
have
for
some
sure.
awareness about some of their most prominent players and the role gambling has played in their own careers.
Yeah, across all sports, but I mean, it is bizarre to me, and I have this argument, living in the Chicago area all the time, and don't get me wrong, like I wasn't the Bulls were not my team
I thought
growing
you were
up,
going to
but
say you weren't alive during the Black Sox scandal. Sorry.
well, that too, but yeah, it's like if Michael Jordan were, in his prime today, and he just took a year off to play baseball, like what? Like give me a break, people. And his dad got murdered on the side of a road. Like it's just very odd that he gets a pass on all this stuff, but people think that gambling's a new problem. And it's like, no, you're right. It's always been there. And yeah, look, I'm not saying there aren't arguments to bringing it into the front, but we still had the mafia involved in this stupid scandal. Like it's still out there. Like people can't pretend like we've just solved it and made, this massive leap forward. It's kind of one step forward, one step backwards. And I don't really get why we want to embrace, gambling as a mindset and gambling as a cultural positive in everything, right? Like again, I'm not saying you should outlaw all gambling or ban all casinos or whatever. I get it. People like to gamble. I do too. But it doesn't need to be overly encouraged, in my opinion. And that's where, like, I just don't know what the NBA or some of these sports leagues thought they were going to get. Like, they pushed gambling and they got gambling, and this is one of the side effects.
Yeah, on the one hand, we want people to be more numerate and to think
Exactly.
probabilistically about more things, and gambling's a good way to teach people about that.
If they actually learn the right lessons, right? A lot of times it's like, oh,
Exactly.
parlays are fun. And it's like, oh, well, sort of.
Yeah, it's a challenging balance to strike. I generally think taking gambling from black and gray markets to legal markets is better than the alternative, but there are really stupid elements to where it's going. Like, why should I read a Nate Silver column on this last week? There are like bench players on really insignificant D1 college basketball teams whom you could have player props on how many points they'll score in a game. Like, why should that
Yeah.
even be a line that someone's making? That's
Yeah,
insane.
100%. No, I think you have to get to a point. And again, I'm generally less is more when it comes to regulation and government. I just want smart regulation. And smart regulation in this case would be just completely eliminating player props like that. It's just ridiculous, right? I mean, the incentives and the human psychology are just too powerful to overcome in that regard, if you ask me. So I think that should be an obvious one.
My God, on the regulation point, I think when you talked about like how weird things are right now, I was thinking, yeah, there are many different directions this could go. And there are many different kinds of very weird things that are happening right now. I saw a hilarious Babylon Bee headline yesterday. Trump vows to nationalize as many private companies as it takes to defeat socialism.
Yeah, right. I mean, I have a running chat with a friend of mine from high school, and he gets like people that are like really mad at him for pointing stuff like that out. And it's like, I think Bernie Sanders went on like the Daily Show or something, and it was kind of hilarious. They're like, Trump kind of stole a bunch of your playbook with this stuff, and he's like, yeah, like what do you say? Like, it's just that's what I mean. Where it's like if you can't like go for a nice walk Like, I like to play golf, so like that helps me clear my mind. Like your head just starts to hurt when you start thinking about all this stuff. It's kind of unbelievable. So I actually have one more thing I want to get to because we're running a little low on time here. I haven't talked to you guys, at least in this format or maybe in general, since the Berkshire meeting about 6 months ago when Buffett made his big announcement that he's retiring. I think we all share an admiration for the man and for the company and the culture that he's built. And so it was actually a really cool moment for me on a personal note. So I took my wife to the Berkshire meeting when she was pregnant with our oldest son. And then this year I took my oldest son for the first time. And we happened to be sitting like right there, 50 feet away when he made the big announcement that he was retiring. And it just kind of was like one of those life events where I was just kind of, it was just very cool and something I always remember. So anyway, I want, John, you have to chime in at this point now. I want both of you to say what you think will and won't change about the company and whether they're going to initiate a dividend in 2026.
Wow, that's a big one. You're putting me on the spot here.
I am putting you on the spot.
Well, I think they're going to try to do everything they can to guard the culture. And I think that'll be the case for a while. I do think, given Berkshire's size and if you assume continued growth, that it does become unwieldy at some point because no one's going to be able to step into Buffett's shoes on all fronts. So I do think if you look out a decade, it may no longer be one company. It may be several companies.
Interesting. What about you, Elliot?
Yeah, I don't want to say I was going to say the exact thing as John, but I kind of was going that way. And I was going to lead with how much cash they're building up right now, which is in some ways reflective of maybe the market environment, but also maybe in some ways reflective of Buffett clearing the deck for the next generation to make some choices as well. But there's just so much cash being spit off by the business in general every single quarter that it's hard to imagine Berkshire staying as one company forever. So I think that might have been sacred in the past, but I could see a day where there's something that gives and it takes a different form. And I think I base this off of nothing at all. That's more likely to happen than a dividend itself is. But I don't think this idea of like centralizing capital allocation and decentralizing operations, like to me, that's kind of the core culture and that seems sacred. So even within any split into multiple companies, that would remain the ethos and the philosophy.
Interesting. Well, I'll answer my own prompt. No one asked, but here you go. I don't think anything's going to change all that much. I think it's going to be at least 5 to 10 years before you can even point to definitive massive changes over the prior 5 to 10 years. I think it's the best executed succession plan in the history of the world. Like, how do you possibly replace someone like Warren Buffett and pull this off? We just lost Charlie almost exactly 2 years ago, right? And hard to believe that now we're going to not have Buffett in the CEO seat in such a short period of time. But I think you will see a remarkable lack of drama. I think the culture, the strategy, the businesses, the balance sheet will continue with very little change or interruption or anything that's bad. If to the good, you could see some real changes if you get a chance to deploy a lot of that cash. We're at $370 billion or whatever it is now after the third quarter results came out. I wouldn't bet on that just because it takes a lot to put that kind of money to work, to say the least. But I actually do think that we'll probably pay a dividend. I think they've thought about this a long, long time, obviously. And I think, some sort of recurring dividend and occasional special dividends has worked really well. That's my preference personally for capital allocation in these types of situations. They haven't bought back stock in like 5 quarters. So that's looking unappealing right now for lots of reasons. You might get a chance to buy back a ton of stock in the future. Who knows? But that's just like, getting good acquisition or investment opportunities. It's really hard to predict. So I actually do think there might be a dividend in 2026. And we'll have to see. As for a breakup, look, nothing lasts forever. It's been 50, 60 years. The next 50, 60 years is a long time out, but it's going to be really hard to effectuate a de facto breakup of the company, given that, some of the insurance companies own some of the major operating subsidiaries, and like an unwind of that would take many, many years to effectuate. So I would doubt that's any time soon, if ever. ever, like in our investing lifetimes type of horizon. So just my 2 cents.
That's very interesting. I'll have to think about that some more because I definitely thought that might be one possible direction from here.
I mean,
Really good point.
it could happen down the road, but A, I don't think Greg Abel would want to do that soon. I don't think there's a need to do it soon. And B, just practically speaking, yeah, I mean, it's intentionally difficult to pull that off, right? I mean, you would need years of work in advance, and you'd have a lot of structural hoops to jump through if you did want to pull that off. So I would take the over on 10 years before you'd see something like that.
Do you think in the future leadership will be as, I mean, I know Buffett set a very high bar, so take a grain of salt with how I'm phrasing this. Leadership can and will be as competent and capable as leadership has been?
Look, I'm as optimistic as anybody on the future of the company, just given how well it's been set up and designed. But there's no replacing Warren Buffett. I think Charlie Munger said it best when he's like, who are you to complain that you get 50 or 60 years of Warren Buffett and then the next bastard's not quite as good? He said something like that, and it's like, yeah, as usual, he's pretty spot on. So.
Well, on that note, Phil, thank you so much for joining us. This was a wonderful discussion. We hope to have you back sooner.
Would love to. We won't make it
later.
as long next time for sure.
Awesome.
Sounds great. Thanks, Elliot. Thanks, Phil. And I hope everyone listening enjoyed this. And we hope to be back fairly soon. Take care, everybody.
Thanks, guys.